Welcome, everyone. Thank you for joining our webinar. We have some great information for you tonight. We're going to be talking all about Snowbirds, specifically looking at tax tips. There's a few items you need to be aware of, a few pitfalls you can avoid. Sometimes there's issues that you need to address, and if you don't do it right away, you can find out after the fact, and that's never fun. And we're going to try to address all of that tonight with our keynote speaker, Angela Preteau. We'll get to her in just a moment. But before we do, our quick disclaimer, you can see all the legalese on the screen there. So please take a moment to look at that. And throughout the presentation, you can contact us. You can participate, simply chat in the comment section. So you can write your comments in either YouTube or on the Facebook comment section. We can see all those questions. We'll address the general questions as we go. And then at the end, we'll open it up and we'll take all the specific questions as well. Kevin and I will just take a moment here in the beginning, 3-4 minutes as an introduction. Then we'll get right in to our keynote speaker, Angela Preteau, and she'll go through all the different tax tips for Snowbirds. So we'll start off with that introduction, talking about the firm involved.
Yes, Clinton and myself, we are members of Becker Orr Wealth Management, and that is a part of Canaccord Genuity Wealth Management. Now, we are the largest independent wealth management firm in Canada. We are managing just south of $95 billion of clients' assets globally. We have offices in Canada, the UK, Australia. We even have some in the United States. We are a global entity, and that's a nice thing to have going forward. We are also a member of what's known as the CIPF, or the Canadian Investors Protection Fund. This is the insurance that the big bank firms have, the same as we do, and basically it's insuring your accounts of $1 million up to, and we've been around since 1950, so 70 years in the wealth management business for us, and we continue going forward.
Yeah, a little background there on the firm. We'll quickly touch on the team, and we appreciate most of you have heard this before. We go through it every time, but we believe it's important. A reminder, the Becker Orr Wealth Management team, you can see us on the screen there, all the full-time members, myself, Kevin, Adam, Alicia, as well as Mark are, and there are some part-time members that help out in addition behind the scenes. And as a team, our promise to each and every client, it is commitment, clarity, and confidence. For us, commitment, it's all about communication. Things change. They change in the financial world. They certainly change in your lives. And we need to make sure those lines of communication are open, and that if we do our job there, it should lead to a high level of clarity. We want a high level of clarity when it comes to the goals, the objective, the fees, all the cards on the table, high level of commitment, high level of clarity, the end result, confidence. Confidence in our team, confidence in our process. Most importantly, we want you to have some peace of mind and confidence with your financial plan. So it's our promise to each and every client. I did mention our process, a little quirky. We call it financial architecture. You can see the diagram on the screen there. The idea is if you're going to be building a house from scratch, it's a big undertaking. You can't just focus in on one area. As much as I love to focus on the couch and the big screen TV, lots has to come before that, before we make that decision. You have to ensure there's a solid foundation, a secure frame. Then we can worry about the interior. Same thing in the financial world. That foundation, that's your estate plan. That's your insurance need. That frame is when we talk retirement planning, tax planning. In the interior are the investments. And tonight is going to be heavy on the tax side, specifically for Snowbirds, will be part of the frame of that financial house. So please keep that in mind throughout the presentation.
Yeah, and it's my pleasure to introduce to you Angela Preteau. She is a partner at Frostiak and Leslie Chartered Professional Accountants. She does specialize in U.S.-Canada cross-border tax matters. She is a certified acceptance agent for the IRS and author of the book, Canadians and the IRS, What You Need to Know About Uncle Sam. So during our webinar tonight, Angela will provide tax tips for Snowbirds, describing pitfalls to avoid, and she's going to talk about tax issues that most Snowbirds don't realize until it's too late to do anything about it. So without further ado, I would like to introduce you to Angela.
Here we are. Angela's going to be joining us. Angela, if you want to start your slideshow, we can add that to the screen as well. You'll have to share your screen again at the bottom, and then I'll be able to pull it up. So we'll work out the logistics here. Angela can share her screen. We'll get the slides on there, and we'll start going through all the different tax details for Snowbirds. Are you able to, oh, I see it popping up here. That looks good. You start the slideshow, I'll add it to the screen, and we'll start going through all that tax information. In the meantime, Kevin can tell us his favorite joke.
He's waiting on the time frame. Without further ado, we have Snowbirds and what we want to do with them.
There we go, Angela. The show is all yours. The slides are ready. Please walk us through.
All right. So as they mentioned, I'm going to talk to you about some tax tips relating to snowbirds for information that anyone would need to know if that's their situation. So what I'm going to focus on are days in the US, differences between immigration rules and the tax rules, and what the substantial presence test is, owning property in the US, rental versus personal use and what that means, what filings are required in those situations, selling a US property, what does FERPTA mean and what that entails in terms of taxes, and then gifting and inheritance tax, the differences during owning property during life and after death. So to start with, for days in the United States, so I'm sure many of you have heard of the requirement that you can't stay in the US over an extended period of time, or you could be considered what's called an illegal alien, right? You generally want to stay away from more than a 6-month period in the US, but there is a difference between immigration law and tax law. So 180 days or 6 months is the magic number of days when you're talking about immigration, and 183 days is the magic number when you're talking about tax law. So immigration law is based on a rolling 12-month period, so over a 365-day period, no matter what month you happen to be in, whereas tax law is applied on a calendar year basis, so January to December, okay? But your tax rules can be applied in a current year or over a 3-year period. So the substantial presence test is a 3-year test as well as a current year test. So the substantial presence test can be matched, like I said, over 3 years when you do a specific calculation, which I'll go through in a little bit. You can be deemed to be a US person for tax purposes if you meet the substantial presence test, but there is closer connection exception options if you meet the test over a 3-year period. You can file what's called Form 8840, and you don't need an ITIN to do this. Some of the snowbirds that are in a situation like this may have heard of this form already. If you're in the US for 183 days or more in the current year, you must file a treaty election claim to claim closer ties. So that actually entails filing an actual non-resident tax return and then using Form 8833 to make the treaty claim. And to do this, you actually do need an ITIN number. An ITIN is an individual taxpayer identification number. Extended absences from Canada can disqualify you from provincial medical coverage. So when we talk about the 6-month immigration rule, that's a standard rule for US purposes as to whether you can be a legal visitor in the United States or if you've kind of overextended your stay. Some provinces have up to 7 or 8 months of an extension of time to be away from the province without affecting your provincial coverage, but that doesn't have anything to do with immigration rules or tax rules, so keep that in mind. So calculating the substantial presence test, you first look at 183 days or more in the current year. So if you're in the US for more than 183 days in one calendar year, then you must file a US tax return to report your worldwide income, unless you can elect out of it using that treaty claim, Form 8833, like I mentioned. So that would mean you'd file a 1040 NR return with a Form 8833 treaty claim claiming closer ties to Canada, because you really don't have any business dealings in the United States. You just spent an extended period of time there over 3 years. To meet the test at all, you have to be more than 31 days in the current year at least. If you're less than 31 days in the current year, then the substantial presence test doesn't even come into play. So if you're in there more than 31 days in the current year, but less than 183, then you would look at a specific calculation of number of days in the current year, number of days in the preceding year, and then number of days in the second preceding year to find out whether or not you meet the test. Okay. So here's an example. So in example 1, if we're talking 2020, that's the most recent tax year that's filed, so I'll do that. So in tax year 2020, this person was present in the US for 120 days. So the way the calculation works is you take 100% of the days in the current year, and then you add a third of the days in the first preceding year, and then a sixth of the days in the second preceding year. So in this example, I have them being in the US for 120 days in each year. When you do the math all the way through, the total is 180 days, which is less than 183. So they do not meet the substantial presence test. So nothing is required to be filed in the US. In the second example, I increased the current year days to 130. Okay. So running that math through, now the person is in the US for 190 days over a 3-year period, which means they're more than 183. So they would be caught by the substantial presence test, which means they would be deemed to be a US person and required to file US tax return reporting worldwide income, unless they file a 1040 NR and submit a treaty claim claiming closer ties to Canada under the treaty guidelines. Okay. As a general rule, if you spend less than 121 days in the US in any given year, no matter what the calculation is, you'll never meet the 183-day test over the 3-year period.
Now, Angela, there's a question I have to ask on that. Does it reset? Like, is it 180 some odd days in a row, or can I go 120 reset for 2 days and then go 120 again, or how does that work exactly?
Well, it's different ways for immigration and tax, right? So for immigration, it's a rolling 12-month period. So even if you come back to Canada for a day or two or a week or whatever it is, you still have to ensure that you track your days for a given 365-day period to make sure that you don't go over that 183 days. There are some, thoughts out there that if you don't come back to Canada for a required period of time, then your time clock doesn't reset. But there's no actual proof in that thought. So it shouldn't matter, because if you're really juggling back and forth with saying, oh, I need to come back for 1 day here and there, you still could get caught over the whole 12-month period, whether it's the rolling period for immigration or a January to December period. So you really just need to keep track of your days, and then you'll know whether or not you're going to be offside at a certain point.
Wonderful. Thank you.
Okay. So owning US property is what we're going to talk about next. So more and more Canadians are purchasing vacation homes in the US. So they have a place to stay when they go down south. Well, who wants to be up here in Canada winters, right? Various tax issues come about when you own property in a foreign country. So it's always good to know what those potential issues are prior to purchasing the property, but especially prior to selling the property. You have the option, if you purchase a property in the US, to rent it and earn rental income. That would allow you to deduct some of your expenses relating to the upkeep of the property, but there are some specific tax rules around that as well, as to whether or not you use it for personal purposes as well as renting it. So you always have to keep that in mind. If it's solely used for personal reasons, so just for a vacation property, then there's no filing requirement that exists on the US or Canadian side until you actually sell it. So for rental properties, there is a base tax rule that if you have rental income and you're not resident in the US, there's an automatic 30% withholding tax that would be applicable on the gross rents that a person collects or is collected on behalf of the person who owns the property. If that's the case and you don't actually do anything to change that, then essentially what happens is that you're not allowed to make any deductions relating to expenses. You simply pay a 30% withholding tax to the US and you're kind of stuck. So what you can do is you can actually complete a W-8 ECI. The ECI stands for Effectively Connected Income. So what that does is you file that sort of with the agent who's withholding or collecting the rents on your behalf, or if you're doing it on your own, you keep that form sort of in your pocket so that if the IRS ever comes knocking on your door and says, hey, how come these withholding taxes haven't been taken? You show that form to them and say, well, it's because the person who owns the property has elected to treat it as effectively connected income and is stating that they're going to file a non-resident tax return to claim their necessary income and expenses relating to the property, and then pay any tax on the net profits rather than on the gross rents. In that situation, you'd be filing a 1040 NR, so non-resident return, and you're only required to report your US source rental income and expenses. The filing due date is June 15th of the following tax year. And then if you're using the property as a rental, if your cost base on the property is more than $100,000 Canadian, then there's also a requirement to disclose the existence of that property on a T1135 foreign income verification statement in Canada. So that form is a reporting form, and there's a penalty for not filing it. So it's always good to make sure that you know the guidelines around that to make sure you file what's required. You would also have to report any net rental profits on your Canadian return as well. So if it's used for personal and rental purposes throughout the year, then it depends on the number of days that you actually use it personally versus the number of days that the property is rented, as to whether or not you have any restrictions on what you can claim in terms of losses or in terms of expenses. One of the main differences with rental income and expenses between Canada and the US is that depreciation in the US is mandatory. So what that is basically when your property is being used, although for general purposes, the value of the property is not going down, but on paper, it's seen to be going down because somebody's using it. So it's deteriorating over time. So that's what depreciation is. And there's specific guidelines and rates that are used in the US as well as Canada. In Canada, depreciation is optional, so you don't need to use it, but in the US, it's mandatory. And the difference is that if you depreciate something and take a deduction today, but then sell it later on, then any depreciation you've taken in a prior period has to be brought back into income up to a certain point. So because the United States requires you to do it on a mandatory basis, they actually include that income inclusion as a part of a capital gain, which is eligible for special tax treatment in the US. In Canada, it's just a inclusion of regular rental income. So it can actually come back to bite you in the butt, on the Canadian side. So a lot of people choose not to take depreciation on their rental property, but it's a situational basis each time. As I said, personal use property has no tax consequence until you sell it. But if you're buying the property from another foreign individual, then there is a possibility that you will need to apply for a taxpayer identification number in the US when you're buying it because of their reporting requirements in the year that they're selling it.
Yeah, I'll jump in quickly with a question there, Angela. And for folks, if you're commenting, please continue to do that. We can see those and we'll try to incorporate them in the presentation and get you an answer as we go. But one that popped up, specific for those that have personal use property. You buy a property in the US, you don't rent it out, you only go there for your own use, for your own enjoyment. In that situation, if you can just clarify, what do people need to know for tax filing purposes?
Essentially, they just need to keep their purchase document for when they first bought it. Any improvements that they make to it, you need to keep receipts for that, so that in the event that you actually do sell it at some point, then you have that information to reduce the gain that you would have to report for tax purposes. Other than that, there's nothing that has to be done throughout the time that you're using it personally. But then also, unfortunately, any expenses that you incur for regular operations, so property tax, condo fees, interest expenses, repairs and maintenance, things like that, those are not deductible. They're just personal expenses that have to be eaten.
Okay, thank you.
You're welcome. So as I mentioned, so selling the property. So when you sell a US property, there's a difference in terms of whether or not you're a US person or a foreign person. So a foreign person would be a snowbird. Anyone who is not considered to be a US person. So a US person is a US citizen or someone who has a green card or is physically in the US on a working visa or things like that. So if you're a foreign person and you're selling a US property, FIRPTA is going to kick in. So FIRPTA is the Foreign Income Real Property Tax Act. So anytime in most countries have withholding tax implications that come up when you have a foreign person that does something with their country because they want to make sure that they get any tax that belongs to them. So the FERPTA tax is a percentage tax based on the gross proceeds amount, and it's taken off right at the onset. So generally it's a 15% withholding tax applied on the gross proceeds, but you can get out of that automatically if you're selling your property for $300,000 or less, and the person who's buying it is going to use the property as their primary residence. So you can't have one without the other. It has to be 300 or less, and the person has to be using it. If one of those is not met, then you're not automatically out of the FERPTA tax and you're subject to the 15%. If the person was using it as their primary residence, but the sales price was over 300,000, then that's when the withholding tax would reduce to 10% instead of 15%. You can request a withholding certificate from the IRS. So that is telling the IRS that the withholding tax that would normally be taken on the gross proceeds is well in excess of the actual tax that a person would owe on that disposition. So you're requesting the IRS to agree that the amount of withholding would be too much so that they'll allow a reduced amount. And I have done those applications for a number of people where they have 0% tax that actually ends up happening because they have a loss or their gain is so negligible that it's under the specific exemptions in the US, so it doesn't actually result in taxes. But there are specific guidelines that you have to go through and a time process that needs to be met in order for that withholding certificate to even be considered. And in some instances, like now, for example, because we're so late into the year and because the IRS is so far behind due to COVID delays, filing withholding certificate applications this year or even towards the end of this year is not something that's recommended because you're going to end up waiting an exceptional amount of time just to get the IRS to process the first stage of it. And there's still a number of things that have to happen afterwards in order for you to have all of your ducks in the row to actually be able to file your tax return to get your money back at the end. So when you're selling a property, if there's any withholding tax, there's tax slips to be done, right? So just like in Canada, when you get T4s, T5s, anything like that that reports taxable income, it has your social insurance number on it. That's how the government identifies you. Well, similar thing in the US, when you're a US person, you have a social security number. When you're a non-US person, you have a US ITIN, an individual taxpayer identification number. So a lot of people don't have them when they go to sell a property. And the process is that you need to apply for one. But again, there's a certain guideline and a certain process that has to be followed in order for the IRS to grant you one and to make sure that your documents have the appropriate information on them so that you have what you need when it comes time to file taxes. So you would have to apply for these when the IRS is required to have a withholding tax submitted for you, because even though the agent would submit the taxes, withhold it on the sale under the FERPTA code, and then submit it to the IRS, if you don't have a number attached to that, then the money is going to sit in limbo land until that happens. And you're not going to be able to get any refund back from the IRS until they have all of their sort of I's dotted and T's crossed to make sure that you have a number, and now the tax that's withheld under your name actually attaches to your number as well. So in order to do the ITIN application, you fill out what's called a W-7 ITIN application form. You have to certify your foreign status and your identity. And the only documents that are allowed to be sort of standalone documents is your passport. But you have to submit a certified copy of your passport or the original passport with the application. And the certified copy can only be certified by the issuing agent, which would be the Canadian Passport Office, or a certified acceptance agent with the IRS. And as they mentioned previously, I'm a certified acceptance agent. So what I do a lot of times is I meet with the people directly. And now due to COVID, I do a lot of video calls and things like that, where I can see the passport on the screen. I look for certain things to know whether or not it's a viable document. It's not a fake or forgery. And I complete the application form. I need to witness signatures, things like that, so that I can verify your identity and your foreign status. It's all of a process, but I have to go through certain steps to make sure that I can legitimately say that, because I can be charged by the IRS if I submit falsified documents or I don't verify that those documents are accurate. So if there are no withholding tax, there aren't any withholding tax that's applicable on the sale of the property, then some people will just apply for the I-10 when they go to file their tax return to actually report the disposition. And there are times when that happens. So even if you were exempted from the withholding tax because your sales proceeds are under 300,000 and the person is going to use it as their primary residence, the withholding tax has no bearing on whether or not that's your actual tax liability. It's just a prepayment or just a technicality of the process that has to be done. So no matter what the situation, when you dispose of a property in the United States, you still have to file a US tax return to report the disposition and show the actual amount of the gain or loss so that the IRS can validate whether or not you owe taxes or not. Depending on the state that you own the property in, there may be a state filing as well. So capital gains are taxable in the US and Canada, no matter what the purpose of the property. So it doesn't matter whether it's for a rental property or just a personal use property. If you sell the property, you're resident in Canada, it's worldwide income based in Canada. So the income is reportable in Canada, as well as the United States. It's reportable in the United States because it's a physical property located in the United States. So you have to disclose that. There is a treaty between Canada and the US. So if you ever owe any tax in the US, federal or state or both, then Canada will give you a full credit for any tax that you've paid down there. So the tax in the US right now, federally, for long-term capital gains is 15%, and it can be up to 20% if the income amount is over $400,000 and some thousand. But the difference is that the United States taxes 100% of the gain at specified rates, whereas Canada only taxes 50% of the gain, and it's at graduated rates. So essentially, whatever your gain is, let's say for argument's sake, it's a $100,000 gain. In Canada, $50,000 of that would be taxable, but it just gets added to the rest of your Canadian income. So it could push you into a higher tax bracket, meaning that you would have a higher amount of tax to pay in Canada than you potentially paid in the United States. The principal residence exemption would be available for a property owned outside of Canada as well, but this is only available on the Canadian side. A snowbird would not meet the requirement in the US to qualify for the principal residence exemption down there. So it's always better to have sort of a plan in place before you just jump the gun and decide to claim the primary residence exemption in Canada for a foreign property. Because if you end up paying taxes down there and then you don't claim the tax credit on your Canadian return, but you own another property in Canada, then you could be creating a situation where it actually would result in double taxation.
Yeah, I have two questions for you, Angela. One specifically for this. Now, you mentioned that you can claim the U.S. residence as a principal residence exemption for the Canadian side of the things. What is the taxation in the U.S. by doing that, and does it differ from state to state?
It does differ from state to state. So there are some states in the US that do not have individual income tax, and then there's some that do. So for example, Florida has no state tax. California does have state tax. Arizona has state tax. Nebraska does not have state tax. Washington does not have a state tax. New York does. So those are just some of the common ones that I see a lot of with my clients where they own properties and things like that. So you have your rates in the US are, like I said, 15% is generally your federal rate that you pay. But for an individual, the first 40,000 of a capital gain is actually subject to a 0% tax rate. So the 15% only applies on the gain over that amount. And then the state tax would be on top of that, but it could be anywhere between 2 to 6%. So not every state has tax, but the ones that do, it's not excessive amounts. It's nowhere near what we pay for provincial tax here in Canada.
Wonderful. That's great to know. I guess I'll be looking at Florida if that's the case, even with the small amount. The second question I have relates actually to something you had beforehand. Now, if I have a property and I rent it out to, say, my brother for 2 weeks at fair market value, is there a time length for how long you can rent it out, or a specific amount that I have to worry about?
If you rent it for less than 14 days, you do not have to claim the rental income, but you can't claim any expenses against it either. If you rent it for more than 14 days, then technically you have to claim the rental income, and then you could claim the portion of expenses that would relate to that income as well, but you'd be limited to expense deduction equal to the income. You couldn't create a loss.
Wonderful.
Great.
Thank
We got
you.
a couple more questions coming in, Angela. Folks, please keep asking the questions, and this all covers what you just spoke about. The first one here has to do with that ITIN. You mentioned getting that depending on the sale, and the question is, would you recommend obtaining an ITIN even if you're not planning to sell your U.S. property in the near future? Does it make sense to get it in advance?
You can't do that. So in order for the IRS to grant you an ITIN, you have to meet a specific purpose to need one. So you can't apply for an ITIN just because you might need one in the future. You can only apply for it when you have the need at present, or the IRS will deny the application.
Okay, well, thank you for that. We got two more quick ones here. This one has to do with withholding tax. You had mentioned a few slides back there could be 15% withholding tax. They're asking if that applies to the entire proceeds or if it only applies to the amount exceeding $300,000.
It's the gross proceeds. So if your proceeds are, let's say, 200,000, but the person is not going to be making it their primary residence, then you don't qualify for the automatic exemption, because it's an and test. You have to meet both of them. So in that case, it would be 15% of the 200,000. If your proceeds are 400,000 and the person would be using it as their primary residence, so you meet the primary residence test, but not the 300,000 or less test, then it's 10% of the 400,000. So it's always gross proceeds. It's never a difference between. The only way you get a reduction in the amount that the withholding tax is applied to is if you apply for a withholding certificate to ask the IRS to agree to reduce the amount based on your actual taxes that might be due.
Okay, thanks for the clarification there. One more quick one, and then we'll move on. This one has to do with the slide that's on the screen, talking about capital gains. Question mentions if the amount due in Canada, we talked about that 50% inclusion in Canada for the capital gain. If you pay U.S. tax, does that reduce the amount of tax you'll have to pay in Canada?
Yes, that's the foreign tax credit. So if you were, let's just, for an example, let's say that you had $100,000 gain in the US and you ended up with, if you had $100,000 gain, remember the first 40,000 is exempt. It's not exempt, but it's subject to a 0% rate. So really you're paying 15% on the 60,000 that remains. Okay. Yeah. So that's for federal purposes. Let's just assume right now it's in Florida. So there's no state tax that's applicable. So it's only the 15% of the 60,000. Okay. Now you come to Canadian wise, you have to report that gain in Canada, but keep in mind that it has to be a Canadian dollar gain. And it's not just as simple as saying, oh, I have $100,000 gain, I'm going to convert that to Canadian. That's not how it works. You have to convert the purchase price at the exchange rate when you bought it. So in the year that you bought it, whatever date that may have been. And then you convert the sales proceeds at the exchange rate on the date that you sold it. So you could end up in this case, maybe your gain in Canada is $130,000. So then of that, half of it is not subject to tax in Canada. So you're only going to be claiming the 65,000, right? But then the tax is whatever bracket you happen to be into. So you still get to use that, whatever the 15% that you paid in the States, you still get to use that to offset the tax on the gain in Canada. But usually you end up resulting in still having more tax owing in Canada, depending on what the rest of your Canadian income is.
Okay, so lots of details there. You do get the credit, but you have to keep in factor the exchange and the fact that Canada usually has higher tax rates, so you could end up still having to pay
Exactly.
a little bit of tax. We have, we'll do one more quick one
Right, so
here,
it all
and then we'll
depends
move
on
on. The
what
last
the
quick
rest
one
of your
here,
income is.
Angela, has to do with that ITIN. Again, that's a popular item here. I'll read you the question. If you have an ITIN as you're renting and then you stop renting for a few years, does your ITIN expire? Is it not valid when you sell?
No, your ITIN will always be your ITIN. Your ITIN could expire. They do have a process where they issue an ITIN. So every 10 years, it needs to be renewed. So if you still have the property and you don't need to be renting it. So let's say you've rented it for 5 years and then you decide not to rent it anymore. You're just going to use it personally. But now the 10 years comes up. You should get a letter from the IRS that says our records show that your ITIN number is up for renewal. So you would still want to renew that so that it's still active if and when you go to sell it later on, because your ITIN would still stay the same. You just don't need to use it until you have an actual taxable transaction later on. But you want to make sure that it's active prior to that transaction coming about so that your refund, if there is one, will come to you faster.
Okay, well, that's perfect. I appreciate that. There's still more questions in the chat window, but we'll let you continue the presentation, and we'll make sure we get back to all those questions before the end of the night here. So I'll let you continue the presentation, Angela.
Okay. So gifting and inheritance. So there is a difference in the US versus Canada in terms of gifting and what happens when a person passes away. So the US have gift tax, which is basically death tax while a person is still alive. And then inheritance is, most people kind of get the confused because there's a lot of people that say, oh, well, you pay inheritance tax in the US, but we don't pay tax on inheritance in Canada. Well, that's kind of a really generic comment because that's not it's not a blanket catch-all sort of instance. It depends on what it is that's being inherited as to whether it's taxed and how it's taxed. And then it depends on whether or not what's being gifted is a US asset or a Canadian asset. So if somebody was a non-resident, so a snowbird, had owned a US property, and they say, well, you know, we're getting on in age. We want to put our kids on title because, we want to make it seamless if something happens to us, whatever. Well, that's considered a gift if that's done during a person's lifetime. And the US will actually tax you on that. Now, it's your obligation as the taxpayer to report that gift. If the IRS were to find out about it and you didn't report it, then there could be significant penalties associated with that. So the big thing there is that US citizens and US residents actually have access to what's called a lifetime gift and estate tax exemption. And a non-US person is eligible for the estate exemption part of that, but it's not eligible for the gifting portion of it. So any gifting of property or any US assets that would have a value of more than $15,000 could be subject to a gift tax, which is paid by the person making the gift during the lifetime. So you'd want to make sure that when you're buying a property, you have the names on title of the people that you want them to be on title, or you transfer the property to your heirs upon your death, because then it falls under the estate exemption piece and it may not trigger a taxation at all from a US perspective. So if the US property, so let's say the US vacation home that you own, is more than $60,000 in value, which most places are, right? You would have to file a US estate tax return. Doesn't mean that there's taxes owing. It just means that you have an obligation to disclose to the government that you have a filing requirement because of this property, but you're going to claim a prorated portion of that lifetime estate exemption that's available to you under the treaty. So right now, the exemption for 2021 is currently $11,700,000. So as long as the Canadians' worldwide net worth is under 11,700,000 US dollars, no matter what the value of the US property is that's included in that estate value, they will never owe US estate tax when they pass away. Because it's calculated by taking the fair market value of the US assets divided by the worldwide asset value multiplied by the $11,700,000 exemption. So, as I mentioned, the biggest thing to take out of this is that gifting property, and some people don't see it as gifting, just transferring title to a child, grandchild, anyone, a spouse during your lifetime is considered a gift and can be a really bad tax situation to get yourself into. So there's more than just physical property that would be considered U.S. assets. So a person's U.S. stocks that are held inside of brokerage accounts can be considered U.S. assets for estate purposes. Most of the time, you don't see those being gifted during lifetime because they're held within a Canadian brokerage account, right? Usually, it's just changing title. From what I've experienced, you just change title on a person's property in the States, and it's very simple to do down there. And I have a lot of people that kind of get caught in that because the agents down there convince you that it's okay to do it because there isn't necessarily a tax consequence from a U.S. perspective, but they don't understand the tax consequence to a non-U.S. person or what it means from a Canadian perspective as well. Because even if a Canadian property would be gifted from an adult to another adult, that would trigger a taxable disposition in Canada because you're giving away an asset that potentially has an income portion attached to it, an appreciated value. So as I mentioned, there's a $15,000 US annual exclusion amount. So any gift on top of that would be taxed at 18 to 40%. So let's say, for example, a vacation home, let's say a husband and wife own it, and it's a $300,000 value. And they say, well, we want to put our 2 kids on it. So now we each want to give half of our interest to our children. So if it's a $300,000 valued property, each of them has $150,000 of value. So they're looking to give away $75,000 of value to each child. Well, that's $60,000 over the annual exclusion. So they would be subject to gift tax on that, probably around 18 to 20%. That's an extra tax on top of regular income tax. It's a specific tax that is applied basically by saying, well, we're not going to allow you to give away your estate while you're alive just to avoid paying tax on it when you die. So and because of that, it can result in double taxation, right? Because you may pay gift tax in the US, then you would have tax on it in Canada for the disposition of it, but it's not the same thing. Gift tax and actual income tax are not the same kind of tax. When you sell the property in the US, you have to report the disposition again, and you didn't have a sale when you gave it away or gave a portion of it away for US purposes. So now you have a difference in Canada and the US of when that tax was paid. So now you have offsetting, or you don't have offsetting tax credits in the same tax year, because tax paid in the US is creditable in Canada, but only in the year that the transaction occurs. You can't carry it forward. And as I mentioned, when you inherit assets, when a person passes away, you inherit them at the market value, but it's eligible to the person who's passed away to be a part of that estate exemption. So there would be no tax triggered from a US perspective. From a Canadian standpoint, it would still be a deemed disposition the same way our Canadian rules work.
Okay, we'll jump in with a few more quick questions here. And I know you just cover this in detail, but simply to clarify, and I'm clarifying because some of our clients have found themselves in this situation. I'm sure they're not alone. I'm sure it's more common, but they buy a property in the US, they make friends down there, and those friends tell them it's really easy to add someone to the title. And then they go ahead and they'll add their spouse or their adult child to the title. But it's not so simple in Canada. Doing that could have some Canadian tax ramifications, correct?
Yes. So when you add somebody to title, it's like you're saying you're selling them a portion of that asset for free. So that's actually a disposition in Canada and would be reportable on your tax return and would require tax to be paid on it if there's a gain. So that's where I was mentioning that you could have now a double taxation problem because you're reporting a partial disposition in Canada, paying tax here, but not reporting anything in the US. But then eventually, when you sell it later on, you still have a taxable disposition from a US perspective. And now your income is not matching up. And you're going to have more tax to pay in Canada on the actual disposition of it, which you already paid some in a prior year. It could end up being double taxed.
Yeah, so it's
And then
certainly
you'd
not a
also have to
decision you
give
want to make.
tax in the US on top of it.
It could be a troublesome activity there. So we'll do one more quick question, then we'll let you get through your example, then we'll wrap up for the evening. The question here, and this goes back a little while in the presentation, but the question is, I want to sell my condo and buy a bigger one in Florida at the same time. So it's not renting, it's for personal use. And they're asking, what is the impact on the tax return?
So if you're selling the property, you have one already and you want to sell it and then buy another one, you would be reporting the disposition on the one you sold in the US as well as Canada. Any tax you pay federal wise in the States would be credited against your tax in Canada on that same income. There's no state tax in Florida, so it's only federal that you worry about. And then you can use the proceeds from that sale to purchase a new one. That's fine. You're just changing ownership from one property to another, but you're triggering a taxable event because you're disposing of something. The one question I get asked a lot is that, well, isn't there a transfer of use, like a like kind exchange from a US perspective, where I'm selling one property and then buying another one of the same type right away, so I could defer the gain? You can do that for US purposes, but you can't do that in Canada. So I recommend not doing that because then you're not mirroring up your foreign tax credit from the US to be used in Canada, and you could end up hurting yourself in the end and being double taxed as well.
Okay, well, I appreciate the advice there. We'll let you go through your example and then we'll wrap up for the evening. Thank you.
Okay. So this example, Mike and Jill purchased a property in the state of Florida in 2018, and they plan to rent it out for 5 years to help cover costs, right, until they retire and then use it personally. Okay, so from a Canadian perspective, it's if the property value is over $100,000, well, not the value, sorry, their cost. If the cost is over $100,000, then they have to report it on a T1135 because they plan to rent it. The rental income is taxable in the US as well as Canada. Okay, so you want to make sure you file the W8 ECI to be able to claim expenses and that kind of stuff. Now, when they change the use from rental to personal when they retire, there's actually a deemed disposition in Canada at fair market value on the change of use. So this would result in potentially a recapture of the depreciation if they've depreciated it in prior years. And then they would have a capital gain in Canada as well. Now, you can file an election in the US to have the same treatment, but generally there are no deemed disposition rules in the US when you change use. It simply just delays the gain that would be considered business income versus personal income when you actually sell the property later on. So in the US, the asset would be included in the non-resident's US estate because they would still own it, assuming they still own it when they died. Rental income is taxable in the US. You'd have a foreign tax credit available in Canada, so no issue there. And the depreciation is mandatory in the US. So a lot of times with depreciation, one thing that's good to mention is that because they make you take it and then based on their rules, a lot of people will end up with no profits from a US perspective when it comes to rental income. They could actually end up with losses. And those losses will carry forward to be used to offset the income in the year that you actually sell it. So not a big deal from a US perspective. As I mentioned, there generally isn't a deemed disposition for change of use in the US. So you usually allocate in the year of sale what would be considered business income versus personal income. It's still capital gains, so not really an issue, but the difference is that you would potentially pay some of the tax in Canada when you change the use, but no tax in US. So you have a mismatch again. So if you end up paying too much tax in the year that you actually sell it from a US perspective, and then you don't have the same level of income in Canada, then you may not be able to use the full foreign tax credit for what you've paid in the United States. So it's always good to just plan for that and make sure that you know exactly what you need to do or what your accountant needs to do to make sure that you match up your tax credits. Okay. So the state of Florida, as it mentioned, all the states are different. The state of Florida does not have individual income tax, but they do have their own estate tax rules. So the $11,700,000 exemption that I talked about before, that's a federal exemption. The state of Florida has their own estate tax rules as well. And I also have to have clients that ask me different questions about ownership structures and things like that relating to Florida property to avoid Florida state probate. So no matter what state that you buy a property in, you need to do some research on the type of taxes and things that are applicable in that particular state and what happens in different situations, just so that you're aware of things and you can kind of plan for it if possible before the event actually occurs. So some strategies in a situation like this is that you could purchase the property in joint tenancy between husband and wife or between however many parties are involved. So you could have husband, wife, son, daughter, two sons, daughter, whatever. Now, what happens there is it reduces the estate value for each person because the value of the property would be proportionately allocated between each owner. Okay. And then joint tenancy in common is key because that means something in terms of estate tax from a US perspective. So if one of the owners dies, that means that it automatically rolls to the people who own or hold the property on their passing. So you don't have to do any sort of extra legalistics on changing the ownership of the property after that fact. You could purchase the property directly within a family trust. That eliminates US estate tax possibilities altogether because US estate tax is only applicable for individuals, not corporations and not trusts. You don't necessarily want to do a corporation because if it's personal use property, you never want to hold personal use property inside a corporation, or Revenue Canada can get on your case and could be a really bad tax result there. But if you're using it as rental purposes only, then a corporation definitely could own a US rental property. You just don't get the same capital gains tax treatment when you sell it because the tax rates for corporations are different than they are for individuals. And then, as I mentioned, you research state laws before you purchase so that you know kind of what to expect in terms of taxation while you own it, tax when you die, tax when you sell it. So high level reporting wise, you'd have T1135 reporting in Canada if your cost is over 100,000. So let's say you had a case where you purchased a property for $300,000, but there's 4 people that own it. Well, the $300,000 value would be converted to Canadian and then divided into 4. If that quarter interest for each person is over $100,000 Canadian, then there would be a T1135 requirement for each person. If it's under 100,000, once you've split it into 4, so each person has their proportionate share. If it's under 100,000, there's no disclosure required. A 1040 NR would be required if it's rented. You need to keep accurate rental records, so track your income and expenses. A W8 ECI would be needed to be completed and sort of kept with the agent who's collecting the rents, so that if IRS knocks on your door, you can legitimately have a basis of saying why the 30% withholding tax has not been deducted. And then you would need an ITIN to file a 1040 NR return. And you have to look at your situation as to when you meet the requirements to apply for that ITIN. Some can apply for it before they need to file a tax return. Some you just have to wait until it's time to file the tax return, because that's one of the options. You're a non-resident person required to file a U.S. tax return.
Great. Well, we appreciate you going through all those details, Angela. That was a lot to cover, a lot to digest. Yes. So we will have a moment here to address any questions. So if you do have a parting question before we sign off, please type it into the comment section and we'll be sure to tackle it. But one takeaway, at least one takeaway I'm getting here, Kevin, is that this is a complicated subject matter. There's lots of details that you're going to have to be aware of, and it's best to get some help. Did you have the same takeaway?
Yeah, definitely anything that I want to deal with the U.S., you want a U.S. tax expert, somebody that can actually know what's going on. And there's not everybody out there in the tax accounting world that can do that. So we really appreciate what you've brought tonight for us, Angela. And again, if there's any other questions that you don't want to do tonight or you want to get in touch with us later, please go to chatwithclintonandkevin.com. We will take the questions. We'll answer what we can. If not, we will get Angela's expertise involved and figure out what we can do from there. So that's another avenue in case there's anything else you want to take a look at that you don't want to present tonight.
Yeah, and that's the best way to do it. Be sure to get some help, ask your questions. Angela will certainly provide her guidance. And then I'm holding up the book here, Canadians and the IRS. This is authored by Angela, also a good resource. If you have questions, feel free to pick up that book. And it looks like no more questions are coming in, so we certainly appreciate everyone joining us tonight. We will make this video available later, so if you want to watch it again, we can send out the link, and that way you can get all the details again, absorb it a second time. And with that, we wish everyone a good night, and we'll be back again very soon with another webinar. Take care.
Take care.